Welcome to Learning Hub GH. If you are new, make sure you subscribe to the channel and you click on the notification bell so that whenever we upload a new video, you will be in touch. So today we are going to learn about types of costs. We are going to look at the types of costs that we have in cost accounting. So the first one is historical cost. Historical cost. And historical cost is a cost that has been actually incurred. So it is a cost that has been actually incurred. It is also known as actual cost. So you take note, historical cost is also known as actual cost. The second one, past cost. A past cost is a cost that has been incurred in the previous period. So a past cost is a cost that has been incurred in the previous period. The third one, prime cost. A prime cost is the sum of all direct costs incurred. So the sum of all direct costs incurred is prime cost. And overhead cost. Overhead cost is the sum of all indirect costs incurred. So overhead cost is the sum of all indirect costs incurred. So direct costs include direct material, direct labor, and direct expenses. And indirect costs include indirect labor, indirect expenses, and indirect materials. So you go to the fifth one, controllable cost. So controllable cost is a cost that can be influenced by the actions of a specified member of an undertaking. So you take it once again. Controllable cost is a cost that can be influenced by the actions of a specified member of an undertaking. The sixth one, uncontrollable cost. It is a cost that cannot be influenced by the actions of a specified member of an undertaking. So a cost that cannot be influenced by the actions of a specified member of an undertaking is referred to as uncontrollable cost. The seventh one, it is the cost of production less direct material, or it is the cost of converting the raw material into finished product. So this is conversion cost. Conversion cost, it is the cost of production less direct material cost, or it is the cost of converting the raw material into finished product. Favorable cost. So favorable cost is a situation where actual cost is less than expected cost or standard cost. So it's a situation where actual cost is less than standard cost or expected cost. Unfavorable cost. Unfavorable cost is a situation where actual cost is more than standard cost or expected cost. So it is a situation where actual cost is more than standard cost. 10. Total cost. This is the sum of all costs incurred. So the sum of all costs incurred is referred to as total cost. Period cost. It is a cost that expires within one accounting period and directly related to the generation of revenue within that period. So it's a cost which expires within one accounting period or one financial year or one calendar year. That's 12 months. And directly related to the generation of revenue within that period. The next one is relevant cost. It is a cost that is affected by management decisions, or costs that are affected by management decisions are referred to as relevant cost. Irrelevant cost. It is a cost that is not affected by management decisions. So costs that are not affected by management decisions are irrelevant costs. Direct cost. It is a cost that can be easily traced to a particular cost unit or cost center. So a cost that can be easily traced to a particular cost unit or cost center is referred to as direct cost. And indirect cost. Indirect cost is a cost that cannot be easily traced to a particular cost unit or cost center. So it is a cost that cannot be easily traced to a particular cost unit or cost center. Semi-variable cost. Semi-variable cost is a cost that is partly fixed and partly variable. So when a cost is partly fixed and partly variable, It is referred to as semi-variable cost. Marginal cost. It is the additional cost of producing one additional unit. Marginal cost is the additional cost of producing one additional unit. 18. Opportunity cost. Opportunity cost is the want foregone in order to satisfy another want. It is the want foregone in order to satisfy another want. It is also known as alternative foregone. So, for example, you have your want to be a laptop and a bicycle, and you can only afford to buy one of them. So, when you go in and buy the laptop, the bicycle become the opportunity cost. And when you go in and buy the bicycle, the laptop will become the opportunity cost. So that's what we mean by opportunity cost. Variance cost. Variance cost, it is the difference between actual and expected cost. So the difference between actual and expected cost is known as variance cost. Incremental cost or differential cost. So you take note, incremental cost or differential cost. It is the increase or decrease in total cost resulting from an alternative course of action. The increase or decrease in total cost resulting from an alternative course of action. Sunk cost. A sunk cost, it is a cost that has been incurred by a decision made in the past and cannot be changed by a decision made in the future. A sunk cost is a cost that has been incurred by a decision made in the past and cannot be changed by a decision made in the future. Out of pocket cost. Out of pocket cost is a cost that requires cost payment to be made, such as wages, insurance, etc. So it's a cost that requires cost payment to be made. And the examples are wages, insurance, and what have you. Joint cost. Joint cost is a cost which is incurred before the stage of production, whereby the product gets separated. Joint cost. Joint cost is a cost which is incurred before the stage of production, whereby the products get separated. Imputed cost. Imputed cost, it's a cost which is specifically computed outside the accounting system for the purpose of decision making. So a cost which is specifically computed outside the accounting system for the purpose of decision making is known as imputed cost. So this is the end of the lesson. Make sure you subscribe to the channel and hit the notification bell to get updated whenever we upload a new video. Thank you for watching.